Hello again, it's North Star here with a look this time at the US dollar. And I thought I'd sort of go through this chart and help to sort of explain some of the charting techniques that I use. And I think some of you probably know my background is in weather forecasting. And in the world of weather forecasting, we look at a lot of variables to try and help us sort of forecast the weather into the future. So it could be temperature, pressure, wind speed, all that kind of stuff. And so what we're looking at here is a chart, but to my mind, it could be a chart of any of those things. It could be a temperature chart showing the temperature rising and falling, or a chart of barometric pressure showing the air pressure rising and falling. But the point is that you can pick out patterns as areas of low pressure move from west to east across the British Isles. We get a very cyclical, repetitious nature of the atmospheric pressure rising and falling. And you can apply those sort of techniques to sort of analysing the movements in the charts, whether it's gold, silver, or in this case the US dollar, or whatever it happens to be. So taking a step back and having a look at it, if you would just ignore what's going on the right-hand side of the chart here, where the TradingView software seems to have dropped the US dollar index down towards zero. Perhaps it knows something we don't. I don't know. But if we ignore that, what you can see is that there's a sort of repetitious nature to the movement of the dollar. Admittedly, the sort of time available on this chart is limited in terms of how many cycles there have been. But you can see that as the US dollar came off the gold standard in the 1970s, we sort of established a pattern where the dollar index would rise and fall, and then it would sort of go through a downtrending sideways pattern. Then it would rise and fall and go through a downtrending sideways pattern, then rise and then fall. Hopefully not quite this much. But you can apply cycle theory to that, and I'm just going to do that by showing a very sort of coarse analysis of the cyclical nature by putting on some time cycles here. So if we sort of set and the way that you do this, by the way, is not by comparing the time between the high points, because the high points can be what we call left translated or right translated. The high that's reached, it can be to the left-hand side or the right-hand side of the cycle, but the low point is much more predictably very close to the low point of the cycle. So if I sort of move this up a little bit so that you can sort of line it up, you can start to see that there's a point in time where the dollar index reaches a low point, then it rises, then it comes down and reaches a low point, then it rises, then it comes down and reaches a low point. So where you put the sort of low point in the cycle is open to a certain amount of debate, really. I would probably sort of put it somewhere around about there, I suppose. So the sort of time period between the lows, if you're starting in 1980, then you get sort of 1995, 96. That would be 25 years, something like 25 years. And then the next one again in 2010, that sort of period. And you can see that the dollar cycle is coming down into a low point in the sort of mid-2020s. As I say, because there's a limited amount of data available, it's still a little unclear just sort of where to place these cycles. But you get the idea. You kind of see how there's this cyclical rise and fall and rise and fall and rise and fall to the dollar. So that's one part of the analysis. I've probably offended a lot of cycles experts there by not being any more precise, because I know there's some firmly held views and beliefs around exactly how long the dollar cycle is and isn't. But I'm keeping things very generalized at this stage. So the topping process, it was a very rapid rise and rapid drop in the first sort of cycle here, and that may well be a function of the fact that we just come off the dollar standard and saw a very sudden sort of reset, and then retrace. But notwithstanding that, you can sort of envisage a sort of a topping formation here that took place within this time period, albeit very, very compressed, sort of topping formation. And you could sort of start placing the arc. You can fiddle around with it, and in fact I've probably put the arc down here, base of the arc down here somewhere. And this is all very much trial and error with the geometry of this whole process until you find the best fit, really. And because the price action dropped away so quickly, it's hard to find an ideal fit for the arc. It sort of went up in more of a sort of an inverted V formation, but you get the idea that there's a sort of a topping period there where price moves up rapidly towards the top of the arc and then drops away, very rapidly. But then the second cycle was more it was more applicable to place an arc formation into the second cycle here, because if you look closely, it's much more satisfying to sort of fit an arc to the price action here, because it actually does fit. And you've got 1, 2, 3 touches on the arc there, one there, well, several actually in that at that point in time, and here as well. So there's that sort of topping formation. I'll just get rid of these cycles, get them out of the picture. So you can see that period there sort of formed a sort of topping process, where the top was around about 120 or thereabouts. The first one was around 160, just above 160, 120, and the latest one, well, it wasn't too far above 100, was it? It's about 103, 104, that sort of level. So each top is lower than the previous one. So the latest arc, which I've fitted onto these charts, goes something like this. I'll just pull the arc out a little bit. This is still unproven, of course, and until we get the final sort of verdict coming in, my sort of theory here is still not proven. But what that says to me is that the first cycle was pretty violent and rapid and extreme as a result of what had happened in the 1970s. So we went up from 80 or 90 on the dollar index to sort of 160, huge sort of appreciation in the dollar index, and then a huge drop. So the next thing that I find quite that stands out is this sort of period here where you get sort of a downtrending sort of period here that's contained within that sort of formation. And then the same thing happened here. So you've got this downtrending and then let's pull this, oops, put that onto there like that, and readjust that. So it's a similar sort of bottoming process or consolidation process with a downsloping upper resistance line and a downsloping support line. There's a downsloping support line there, same there. What you'll notice when you compare when gold price peaked is that gold price peaked in 2011, wasn't it? And the dollar index hit its low point in 2008. So the gold price peaked over here in 2011 on the secondary drop of the dollar that didn't quite get as low as the first. And the same thing was the case over here. The dollar reached its low point in 1992, but gold price peaked later on in 95 when the dollar had a secondary drop that wasn't quite as low as the first. So it strikes me as odd that that would happen there and then the same thing happened here. We've got a topping process, a downtrending bottoming process, topping process, downtrending bottoming process. So I'm reasonably confident that this is another topping process going on here, not a launch pad for a move to higher highs of any sort. So what's going on at this precise moment in time is that we've got a sort of an uptrend within the developing bear market in terms of the dollar index. We could go back up and retest the arc again, which is somewhere, well, the way that I've drawn it here is somewhere around about 97, give or take. But you could sort of draw the arc to that sort of upper spike there and start fiddling around with it, and you get sort of higher, sort of a higher point where the arc can be sort of tested to. If we zoom in a little bit, I'll get it a little bit more satisfactory. So something like that, which gives you 98 or 99 even if the dollar index was to move up vertically at this point in time. But I suspect it's going to move in a bearish wedge to around about 95 or 96 and then drop very rapidly. I don't think we're going to get to the point where we can retest the edge of the arc. It could happen. If it was going to happen, I'd expect it to come up to here somewhere around the 96 level and then drop very rapidly. But I don't think we're going to see the dollar rising through until early next year. Could be wrong, of course, and we could see the dollar rising to that point. Doesn't necessarily mean, if that happens, of course, doesn't necessarily mean that gold has to fall either, because during this period here, 2018-19, the dollar index was rising, and so was the price of gold. So we could have another period where the dollar index is rising, and so does the price of gold, although it'll slow down the rate at which gold is appreciating in value, as it did here. Of course, when we saw this big drop here, gold price really took off. So gold is in a bull market and will, I suspect, rise almost regardless of what the dollar is going to be doing over the next few months. I think if the dollar carries on rising, gold will overcome that and start to rise anyway. But as soon as the dollar starts to resume its downtrend, then the turbo boosters will be put on in terms of gold price, and we'll see gold price accelerating away to the upside again. So that's a little sort of view of how I analyse the dollar index anyway. And you can also, one thing I haven't done is put this onto the 3-monthly quarterly chart, and that will give you also an idea of what another sort of indicator as to why I'm bearish on the dollar is because we've seen the MACD indicator have a bearish cross on the quarterly chart, which obviously doesn't happen very often, quite a rare event. So we've had a bearish cross. If you look at the numbers on the left hand side here, you can see 1.8 and 2.4. So the blue line is below the orange line, and if I zoom in, you can see that there, look. So the MACD indicator is telling us that momentum is going to take us downwards. And similarly with the CCI indicator, when the CCI indicator breaks that level there, you can see what happens to the dollar index. It drops rapidly. Same thing happened back here when the CCI indicator broke out of that shaded zone. the dollar index dropped like a rock. So perhaps this line TradingView has inadvertently put on here is our trend line for the next few weeks, and price is going to drop rapidly. Joking, of course. I don't think it's going to fall that far that fast, but nevertheless, that's the way I see it, and that's hopefully that's given you something to think about. As always, keeping an open mind. You have to, in weather forecasting, never let reality get in the way of a good forecast, but you have to always